There is this very specific, like, visceral type of panic that sets in when you log into your bank account and the app just endlessly spins.
Oh, absolutely. It's the worst feeling.
Right. Or, the website is suddenly down for quote-unquote unscheduled maintenance.
Yeah, that's never a good sign.
No, it's not.
Yeah.
We've all had that fleeting, terrifying thought, like, what if my money is just, gone?
It's a very real fear.
It is. Welcome to the deep dive.
Yeah.
Because in 2022, some of the wealthiest tech innovators in the world realized their money actually could vanish when major institutions collapsed over a single weekend.
Yeah, that was a wake-up call for a lot of people.
A huge wake-up call. So today, we are looking at the government's own playbook. We have a guide called Guardian of Your Deposits, a guide to FDIC insurance. And the mission here is to figure out exactly how the invisible safety net beneath your checking account works.
And probably more importantly, precisely where that net suddenly ends.
Exactly. Leaving you in free fall. Because it is a piece of financial infrastructure that operates completely in the background.
Totally. I mean, we swipe our cards, we direct deposit our paychecks, and we just, assume a baseline level of security without ever really questioning the mechanics of how that security is funded or maintained.
We just trust the system.
Right. But the moment an institution begins to wobble, well, understanding those mechanics becomes the most important thing in the world.
Okay, let's unpack this.
Yeah.
Because understanding the FDIC is essentially like knowing where the emergency exits are on an airplane.
I like that analogy.
Right. You really hope you never actually need to use them, but you absolutely want to know exactly how the latch works before the cabin loses pressure.
Exactly. Because bank failures are not just, dusty history lessons from black and white photo.
No, not at all. Our sources actually show it is incredibly common to have at least one bank failure a year in the U.S., and we've seen some of the largest in history just recently.
What's fascinating here is that the FDIC itself was actually born out of pure, unadulterated panic.
Really? Just pure panic?
Oh, yeah. If we look at the origins in 1933, right in the teeth of the Great Depression, this legislation was a desperate response to the 1929 stock market crash.
Wow, okay.
Yeah, we aren't just talking about a standard recession here. We are talking about people's literal life savings vanishing overnight when the bank's doors just, padlocked.
That is terrifying. Just showing up and the doors are locked.
Right. And the fundamental issue back then was a contagion of fear. So the primary job of the FDIC wasn't just to replace lost money.
What was it then?
Its real job was, and frankly remains, to engineer public confidence in the entire banking system.
I see. Because if we all believe the money is safe, we don't all run to the bank at the exact same time to withdraw our cash.
Exactly. It's the run itself that causes the bank to collapse in the first place.
Ah, so the FDIC is a psychological shield, just as much as a financial one.
That's a great way to put it, yeah.
But to maintain that psychological shield, there have to be rules, right? And the most famous rule, the one that seems to trip everyone up, is the hard limit on the guarantee.
Yeah, the magic number. The golden rule established in the guidelines is that your deposits are insured for up to $250,000.
$250,000, okay.
But the specific phrasing is where the nuance lies. It is not a flat $250,000 across the board for everything a single person owns.
Wait, it's not?
No, it's not. The protection is calculated per depositor, per FDIC-insured bank, per ownership category.
Okay, I have to push back here, because this is where the logic seems to kind of break down for me.
How so?
Well, if the whole point of this government agency is to prevent a psychological panic, capping the protection at $250,000 seems like it inherently causes a panic for anyone who isn't just, like, a college student.
I see what you're saying, yeah.
Think about it. If you just sold a house, right, and you parked the cash while waiting to close on a new one.
Sure.
Or if you run a mid-sized plumbing business and you need to make a $300,000 payroll next week, that limit is terrifyingly easy to hit.
It really is, yeah.
So doesn't this hard cap actually trigger bank runs the second a business owner senses trouble?
Well, that is a very real tension in the system. But we have to look at the mechanism of how the FDIC is actually funded.
Okay.
It is not a blank check written by the American taxpayer.
It's not.
No, not at all. The FDIC is essentially a massive insurance pool, and it's funded by premiums paid by the member banks themselves, along with earnings from investments in U.S. Treasury securities.
Oh, I had no idea the banks paid for it themselves.
Yeah, exactly. So if the FDIC offered unlimited protection to massive corporate payroll accounts or, multi-million-dollar real estate deposits, the insurance fund would need to be astronomically larger,
Which would mean?
which would require crippling premiums on the banks. They wouldn't be able to operate.
Okay, that makes sense.
So the $250,000 limit is a calculated actuarial line in the sand. It's designed to protect the vast majority of everyday retail consumers while keeping the insurance fund solvent.
So it's a strict mathematical boundary.
Very strict.
Meaning, if you have $300,000 sitting in a single savings account, $250,000 is protected, and that remaining $50,000 is just completely exposed to the wind.
Entirely exposed, yes.
Wow.
And beyond the dollar amount, the FDIC draws another very strict line regarding the actual type of money it protects.
Right, the VIP list.
Exactly. The FDIC only covers traditional deposit products. So that means checking accounts, savings accounts, money market deposit accounts, and certificates of deposit, or CDs. That is the VIP list.
Okay, but what about investments? Because I actually looked at my brokerage statement yesterday,
Okay.
and it had my bank's logo right at the top of the page in, like, high resolution.
Oh, I'm sure it did.
Yeah, and I bought a mutual fund and an annuity literally sitting in the lobby of my local brick-and-mortar bank, talking to a representative who works there.
Right.
It feels incredibly protected by association. But the source explicitly leaves investments out in the cold.
Completely out in the cold, yeah.
It honestly feels like a warranty that covers your car's engine, but explicitly voids coverage for the custom rims you buy at the exact same dealership.
That's exactly what it is. And the visual branding is absolutely designed to make you feel safe, but the distinction really comes down to the type of risk involved.
Okay, what do you mean?
Well, the FDIC is designed to protect you against institutional custody risk.
Institutional custody risk. Meaning?
Meaning the bank itself going bankrupt and losing your stored cash. It is explicitly not designed to protect you from market risk.
Oh, I see.
Yeah, when you buy a stock, a bond, a mutual fund, or, an annuity, the value of that asset fluctuates based on the open market.
Right.
So if the stock market crashes, the government is not going to step in and reimburse your portfolio. You are assuming the risk of the asset's performance.
Okay, that makes sense. The government isn't going to cover bad investment choices. But what about physical stuff? The source guide also brings up safe deposit boxes, which I found completely wild.
Oh, yeah. This surprises a lot of people.
Because people think physical cash or gold in a metal box inside a bank's concrete vault is the absolute safest place on earth.
Right, it feels secure.
But the physical contents of a safe deposit box are completely uninsured by the FDIC.
Completely uninsured. Because a safe deposit box is not a deposit on the bank's balance sheet.
Wait, what does that mean?
Well, when you put money in a checking account, the bank takes that money and lends it out, right? It becomes part of the institution's ledger.
Okay.
But when you rent a safe deposit box, you're simply leasing physical real estate. It's just a tiny metal room that you rent from the bank.
Oh, wow.
Yeah. The FDIC insures the bank's financial ledgers, not the physical items stored in the building's basement. So if the bank burns down or is robbed, you have to rely on the bank's private hazard insurance or your own homeowner's policy, not the federal government.
That is wild. Okay, so we have established the boundaries. We know investments and physical boxes are out.
Yeah.
We know checking and savings accounts are in. And we know the hard limit is $250,000.
Right.
But earlier you mentioned the phrase per ownership category.
Yes, this is crucial.
Because the source details how individuals can actually legally use the FDIC's own definitions to protect millions of dollars at a single bank. How does that work?
So this is the strategy of maximizing ownership categories. The FDIC recognizes different legal ownership types, and each category gets its own separate $250,000 limit.
Okay, so what are the categories?
The most common categories are single accounts, joint accounts, and trust accounts.
Right.
So if you have a single savings account with $300,000, as we discussed, $50,000 is uninsured.
Right.
But if you hold funds in a joint account with a spouse or a partner, the math fundamentally shifts.
Because it's no longer just one depositor.
Correct. The FDIC rules stipulate that joint accounts are insured up to $250,000 per co-owner.
Per person. Wow.
Yes. So if two people have a joint checking account, the limit for that specific account category instantly becomes $500,000.
That's a huge jump.
It is. If you have $475,000 sitting in that joint account, every single penny is fully insured.
Okay, the guide also digs into trust accounts, which seems to take this to an entirely different scale.
Oh, definitely.
If someone sets up a revocable trust, the insurance isn't based on the person who opened it, but rather on the people who will eventually receive the money, right?
Exactly. The beneficiaries.
Right.
The FDIC provides up to $250,000 in insurance coverage for each unique eligible beneficiary named in the trust.
Okay, so let me do the math. If an individual sets up a trust naming 5 different beneficiaries,
Then that single trust account is federally insured for up to $1.25 million.
$1.25 million. Wow. So what does this all mean? The best way I can visualize this, it's not just a flat ceiling, right? It's like a waterfall system, or like financial Tetris.
A waterfall is a great way to picture it.
Yeah. So the water, which is your money, flows into the first glass, which is your single account. But that glass can only hold $250,000.
Right.
If you keep pouring, the water just spills over the edge and is permanently lost to the floor if the bank fails.
Yeah, it's gone.
To protect the excess, you have to strategically place overflow glasses beneath it. You set up a joint account glass to catch the spillover. Then you set up a trust account glass to catch the rest.
Exact.
You are basically organizing your wealth so that no single glass overflows its specific capacity.
And if we connect this to the bigger picture, the FDIC is offering an incredibly powerful framework for wealth preservation that requires literally zero fees or complex offshore maneuvers.
It's just organizing the blocks.
Yeah. You are simply leveraging the legal definitions of ownership. And honestly, if managing all those different category glasses at one bank feels too convoluted, the ultimate fallback is just opening single accounts across multiple different FDIC-insured institutions.
Because spreading the cash across different banks resets the limit every single time.
Exactly. You get a fresh $250,000 at each new bank.
Right. But because managing these complex waterfall structures and spreading money all across town is so cumbersome for, say, a busy small business owner or an individual, mistakes happen.
They happen all the time.
The glasses overflow. And here's where it gets really interesting, because the source material brings up the absolute nightmare scenario when that overflow is left exposed.
It's not pretty.
Let's talk about the anatomy of a bank failure. You wake up on a Saturday morning, you check Twitter, and you see that your bank has been seized by regulators. What actually happens to the money in those glasses?
Well, the FDIC has a very practiced choreography for this. They actually almost always seize a failing bank on a Friday afternoon, right after close of business.
Why Friday?
To give themselves the weekend to sort it out without causing a panic during trading hours.
Smart.
Yeah. So for the money that was properly shielded within the limits of your insured funds, the process is remarkably frictionless.
Really? No paperwork?
Barely any. The FDIC works over the weekend, and by Monday morning, they have either facilitated the transfer of your insured deposits to a healthy acquiring bank, or they are actively issuing you a check.
Wow.
Yeah, you do not have to hire a lawyer. You do not have to file a massive insurance claim. Your insured money is available to meet payroll or buy groceries almost immediately.
And if you don't like the new healthy bank they transferred your account to, I assume you just wire the money out on Tuesday and go somewhere else.
Exactly. It's a seamless transition.
But that is only the story for the insured funds. The source outlines a very grim reality for the water that spilled onto the floor, the uninsured funds.
Yeah, for uninsured deposits, you step into a completely different reality. You basically become a general unsecured creditor of a dead institution.
Unsecured creditor, that sounds bad.
It is. The FDIC assumes the role of a receiver, which means they are tasked with liquidating the failed bank's assets.
So they're selling off everything.
Everything. They have to sell off the bank's real estate, their office furniture, and their portfolios of auto loans and commercial mortgages. And this liquidation takes years.
It's just a slow-motion fire sale.
Yes. And as the FDIC manages to sell off those assets, they issue periodic dividend payments to the uninsured depositors based on what are called receivership certificates.
Receivership certificates.
Okay. Basically, you are hoping to recover cents on the dollar over a timeline you have absolutely no control over.
That is brutal. And we saw this play out in real time with Silicon Valley Bank, right?
Oh, absolutely.
Because the data from the end of 2022 showed a staggering 94% of SVB's total deposits were completely uninsured. 94%.
That's a wild statistic.
You had the most advanced, highly educated venture capitalists and tech innovators in the world, and they were caught entirely exposed.
Yeah, they were.
They had multi-million-dollar company treasuries sitting in single accounts. They just completely ignored the 1933 waterfall strategy, assuming, I guess, the prestige of the institution made it immune to gravity.
Well, it is a stark reminder that institutional prestige does not alter the mathematical limits of deposit insurance.
Math is math.
Exactly. If a multi-billion-dollar tech company leaves $10 million in a standard commercial checking account, they're taking the exact same unsecured risk as anyone else.
Right, but because managing these complex trust and joint account limits across traditional banks is so cumbersome, millions of consumers have flocked to the sleek, frictionless apps on their phones instead.
Yeah, the fintech boom.
Exactly. We were talking about fintechs and neobanks, things like Cash App, Chime, or Venmo.
Right.
They have beautiful user interfaces, neon-colored debit cards, and they seem to offer this modern escape from clunky legacy banking. But that convenience masks a massive loophole.
This is a critical vulnerability that the source text highlights. Consumers look at these fintech apps and they see an FDIC logo buried in the footer of the website, right?
Yeah, you always see it down there.
So they assume the app itself is a federally insured bank. But fintechs are not chartered banks. They are technology companies.
Wait, really? Just tech companies?
Yes, they do not have their own direct FDIC insurance. Instead, they rely on a mechanism called pass-through insurance.
Okay, pass-through insurance. So the app takes my money and just passes it through to a traditional chartered partner bank to hold in a master account.
Essentially, yes.
But the actual bank holds the cash, so the FDIC protection still applies, right?
It applies, but only to a very specific failure.
Uh-oh.
Yeah. The pass-through insurance protects you if the partner bank fails. If the legacy brick-and-mortar institution holding the master account goes under, the FDIC steps in to protect the depositors.
Okay.
But what happens if the partner bank is perfectly healthy and it is the tech startup, the app itself, that runs out of venture funding and goes bankrupt?
The FDIC doesn't care.
The FDIC does not have the legal authority to step in and make you whole over a weekend if a software company fails.
Wow.
If the fintech app goes bankrupt, your funds are suddenly tied up in the tech company's bankruptcy proceedings.
So you're not getting that Monday morning check.
Not at all. You are no longer dealing with the swift Friday to Monday FDIC resolution. You are navigating standard bankruptcy court, fighting alongside the app's software vendors and commercial landlords to get your money back.
You are unknowingly trading actual ironclad federal security for like a slightly better user interface and instant notifications.
That's exactly the trade-off.
And to make matters worse, the source notes that even for the pass-through insurance to apply when the partner bank does fail, there are strict conditions.
Yes, and this raises an important question about the behind-the-scenes operations of these tech companies.
Okay.
For pass-through insurance to be legally valid, the FDIC requires the fintech to maintain meticulous ledger-by-ledger records, identifying exactly which user owns what fraction of the money sitting in the partner bank's master account.
So they have to have their books perfectly in order.
Perfect. If the fintech's internal accounting is sloppy or, their database gets corrupted during a collapse, the FDIC cannot identify who is owed what, and the pass-through protection effectively evaporates.
That is genuinely terrifying. But we have covered some heavy mechanical realities today. So let's recap the vital tools the source provides so you can actually verify your own safety net.
Good idea.
First, never assume you're fully covered just because a bank is famous. You have to calculate your coverage based on the $250,000 limit per depositor, per bank, per ownership category.
Exactly.
Second, utilize the waterfall strategy. Understand how joint accounts and trusts can legally expand your protection.
Yeah.
And finally, the FDIC provides a tool called the Electronic Deposit Insurance Estimator, the EDE, where you can input your specific account structures to see exactly what is covered and what is spilling onto the floor.
That tool is incredibly helpful.
It is. You should also use their Bank Find Suite tool to verify your institution is actually a chartered member, rather than just a tech app borrowing a logo.
Those verification tools are essential, especially as the landscape of where we store our wealth becomes increasingly abstract.
The overarching theme here is that the safety net exists, but you are entirely responsible for making sure you are actually standing over it.
Very true.
Before we wrap up, what is the one thread from this deep dive that we should keep pulling on?
Well, we spent a lot of time discussing the mechanics established in 1933. The FDIC was built to stop bank runs that happened at the speed of a horse and buggy, or maybe a telegram.
Right. Very analog.
You had to physically stand in a line outside a brick building to demand your cash, which gave regulators time to react. But as we saw recently, a modern bank run happens in 30 seconds on Twitter.
Yep.
Billions of dollars are withdrawn via smartphone apps before the FDIC even finishes their morning coffee. So the question we have to ask ourselves as we look at these guidelines is, can a regulatory framework designed for the analog era actually catch us when panic moves at the speed of the internet?
A brilliant and slightly terrifying thought to leave on. Thank you for joining us on this deep dive into the invisible machinery protecting your wallet. Be sure to subscribe and share this with anyone who might have a little too much water sitting in one glass. We'll catch you on the next one.